Hi everyone, my name's Brad Dunn and I'm joined today by Damien Collins, our chairman, and also Simon Worth, our head of capital acquisitions for Westbridge. We're going to be talking today about our latest opportunity, the Westbridge Retail Centre Fund, which is of course located in Wagga Wagga. Quite a few people aren't even aware of Wagga Wagga, so what we will do is cover off on that as we go through. Okay, let's get into it. Okay, so as I was saying, we're joined today by Damien, who's the chairman. So, Damien,
Nice to see you, Brett.
you too, so people know who you are. It's all good. And Simon,
Thanks, Brad, for having us.
excellent, excellent. And we'll be running through everything. Let's get into a bit of housekeeping just before we start, though. This webinar is being recorded, so if you're unable to see the whole show, then that is fine. On demand just means that if you ask, we can send you a copy on completion. Presentation will be followed by a Q&A, and you will actually be able to submit questions via our Q&A function, which I'll show you in 1 second throughout the presentation. So just at the bottom of your screen, you should be able to see a Q&A button where you can just type your question in. Last time we've done one of these, we had quite a number of questions, so we will endeavour to try and get through everyone's. But if you don't, please make sure you put your name in there. And what we'll do is we'll be able to follow up, give you a call and actually run through the questions if they're not covered off in the Q&A side. Okay, let's get into the agenda. Now, I'll start by giving a bit of a brief overview around Westbridge Funds Management. We'll then move into the actual opportunity itself, which Simon Worth will be covering off on, plus all the investment highlights and where he sees, why he likes it, the whole bit. Damien's then going to be covering off from more of an economic perspective around what is large format retail, why we like it. Of course, we're going to be talking about interest rates being such a big topic at the moment, and then Damien will cover off around how to invest. Let's get into it. Okay, first of all, disclaimer. It's our standard thing that we do need to say. Information is of a general nature and doesn't take into account your individual circumstances. Please always seek personalised advice before making a decision to invest. And for full information and on the risks and returns, please refer to the fund IM or information memorandum that we can send out to you. Okay, let's talk a bit about Westbridge itself first. We've been helping people for over 20 years and we're now built up to a point where we're 943 mil in assets under management. I know Damien will be excited when we click over that 1 billion mark, but we're close, but not quite there. But the one I'm most proud about is definitely the fact that when our investors invest with us, they invest multiple times. In fact, on average, our investors have been investing with us 3.7 times, which is fantastic to see, a testament that we must be doing something right. In terms of the portfolio, that 943 is made up of predominantly industrial and retail, as you'll see. Now, I will make a proviso that not all retail is retail, as a lot of people tend to point out to myself. We will explain further in why and what sort of retail we do like. And of course, industrial, I'm sure people have seen over the past 5 to 6 years, has performed significantly well. We still see opportunities going forwards with that, and Damien will be covering off on that further in. We have been diversified around Australia. Of course, WA being our home state is predominantly there, but we have also got across all states except for Northern Territory to date. Let's get into some of the average annual returns. So essentially, this is just the average annual return that we've seen across every single fund we've got. What we've done is we've tried to bundle them into 3 different separate groups. The first of all, those dark blue ones down the bottom, they're our diversified funds, which is just large, good quality assets located around Australia, generally with big ASX listed or national tenants in place. And you'll see over time, they tend to perform quite strongly. Then in the middle there is our single asset income funds, which would include this latest opportunity that we do have. Fear not, both Kewdale and Tamworth are showing slightly lower returns only because they've only just started. I believe Kewdale is on track, distributing out at 8%, and Tamworth's distributing at 7% and should grow over time. Bankshire, of course, and Forestdale, you can see from the years held, that's generally how they've performed. And then finally, we've also got a range of income and value add funds with a bit more moving parts to them who will also perform quite strongly over time. We're not alone. It's not just Damien, Simon, and myself here. We've got a nice large group of management team experts, and under us even more so with a team across the group. In fact, across the Momentum and Westbridge group, I believe we're close to 70 odd staff. Is that right, Damien?
I think it's 80, Brad, but I'll do a head count later.
There we go. Either way, we've got a lot of support. It's not just us. We've got a great team around us. I'd like to actually shout out to my own personal team, the Key Relationship team. We are here throughout any of these opportunities to give you any advice you need in regards to general questions around the fund, the opportunity itself. We're even here to help you through any sort of application forms and basic level things that you may need help with. So just pick up the phone anytime, and that's what we are here to help with. Okay, let's get into it. I'd like to now introduce our Head of Acquisitions, Simon Worth, to give us a rundown of the opportunity. Simon, I'm just handing control over to you now.
Thanks, Brad, for the introduction. We're very excited at Westbridge to present this excellent opportunity. We've secured Home Centre Wagga Wagga in New South Wales. It's a modern, fully leased, large format retail centre constructed in 2014 in the heart of Wagga Wagga. The centre has a total GLA of 16,860 square metres on a huge strategic 4.1 hectare site on Hammond Avenue, which is a direct link coming from Sydney and Canberra into the centre of Wagga Wagga. What we like about this opportunity is it's an excellent blend of strong income as well as the ability for good, strong capital uplift. We're forecasting a 7% target monthly distribution, a 13% target internal rate of return over a 7-year time frame. The other compelling reason for this investment is we are purchasing it at a huge discount of 45% to the replacement cost, given the high construction costs, the difficulty finding appropriate zone sites. This sort of equates to about a $20 million discount to the purchase price. So why we like this opportunity? As I mentioned, it's a strong income stream. It's underpinned by blue chip tenants, including national brands like Spotlight, Anaconda, Supercheap Auto, Autobarn, Petstock, and a number of others. The property has a number of value-add opportunities to drive capital growth. This includes the ability to capture strong rental growth with the property currently under-rented, and on completion, the property will, on completion of the two pad sites being on Portos and Kickstart Coffee, the centre will be on 4 individual titles. This gives us flexible exit strategies to sell down individually should market conditions support that sell down in the future. Wagga Wagga is a thriving location. It's a high growth regional hub and is the largest inland city in New South Wales. The LFR sector is a high growth asset class. With limited supply, high construction costs, and strong investor appetite, it is well positioned for continued growth. The centre is fully leased, as I mentioned, and anchored by major national and ASX-listed retailers, as I mentioned, including major brands like Spotlight, Anaconda, Supercheap Auto, Petstock, and Autobarn. It has a strong national brand presence with 71% of the gross lettable area weighted towards retailers with over 50 stores nationwide. There's also an excellent weighted average lease expiry of 6.74 years by income. This takes me to the value add opportunities. As I mentioned, on completion of the Portos and Kickstart developments, the property will comprise 4 individual titles. This allows individual sell down of the 2 LFR centres, which are 2 individual buildings on 2 separate titles, and also the Portos and Kickstart, which are also on separate titles. This gives this flexibility. It gives us the ability to sell down individually at various stages of the fund life, depending on market conditions and whether the pricing premium can be achieved. Further value add is approximately 80% of the lease space is currently under rented, presenting a strong opportunity to increase rental income as leases renew, driving higher rents. The majority of leases were set 4 or 5 years ago, and there's been definitely a spike in large format retail market rents in the last few years, given the cost of construction, the scarcity of sites to find, and population growth and strong demand from these retailers. Here at Westbridge, we did a bit of a gap analysis to work out what large format retail brands are not currently represented within the Wagga Wagga catchment area. As you can see, there's some big brands that still aren't trading in Wagga Wagga. You've got like the likes of Bed Bath and Table, Beacon Lighting, King's Living, and Freedom, to name a few. Again, as I mentioned, the high construction costs and lack of suitable zoned land are constraining future supply for the large format retail development. And this again will enhance the ability to drive further rental growth in the future. Now, why Wagga Wagga? Well, Wagga Wagga is a thriving location. It's at the midpoint between Sydney and Melbourne, with close proximity to Canberra and direct links into Adelaide. Wagga Wagga is a regional hub in New South Wales and attracts significant government and business investment due to this strategic position. The high growth location is the largest inland city in New South Wales, with a current catchment of 121,794 people and a population forecast to increase by over 21% by 2036. There's strong demand in Wagga Wagga. It's a critical centre for education, defence and infrastructure projects. It has a diverse economy with a gross regional product of 5.4 billion in FY 22-23, which was up 208 mil on the previous year.
And from what we can tell, a hell of a lot of farmers and agriculture around there from all the calls we're getting from them as well, right?
It is absolutely, Brad, that's correct. Again, it's ideally the property on Hammond Avenue. It has 275 metre frontage to Hammond Avenue, and this is the main thoroughfare into the Wagga Wagga CBD when travelling from Sydney and Canberra. So it's a high exposure site. I'll now hand it over to Damien to talk about the large format retail sector and the economic outlook.
Thanks, Simon, and thanks, Brad, for that introduction, and thanks, Simon, for your update there on the asset. So why do we like large format retail? You would have seen at the earlier on in our presentation, we're about, as a fund manager, we're about 60% of our assets are in industrial, roughly 30% retail, and not all retail is the same. And we very much decided 7-8 years ago that we could see the change in distribution that was coming out of the US with online delivery and online ordering was really starting to pick up. And so we looked at the market and thought, which sectors are going to benefit the most? And clearly, industrial logistics and distribution is the area that's done particularly well. But ultimately, you still got to get goods to people's houses, and bulky goods, not certainly a lot less bought online. People still like to go into the stores and touch and feel them. But also importantly, people like to order online and just go to a place where they can easily pick up goods. And as Simon mentioned, there's heaps of parking out the front, very easy to pop into one of these stores, even if you've ordered online, and pick up those goods. And we all know, but most of these retail operators now operate click and collect. So that was really important for us. The retail sector needed to be efficient the way it got the goods to people. And that means they like certainly low cost centres. And this is what large format retail is. You can see it doesn't have big indoor malls, doesn't require security and cleaning and all those things. It's got big open car parks, nice big box centres where people can go in, and that keeps the rents certainly a lot more affordable for these retailers. And so most of the retailers in Australia are now looking at this is their distribution model. It's very expensive to deliver from one warehouse. Their distribution model is people come to these large format retail centres, and that's why we're still continuing to see growth. And particularly when you get into a regional area, it's unlikely that someone's going to be buying something and it's not efficient for a retailer to ship it out of a Sydney warehouse all the way out to Wagga Wagga. So certainly I think if anything, the large format retailer is safer and stronger in these regional areas, because that will be the distribution methodology. They will be distributing from these large format retail centres. And the rents are very competitive. As Simon mentioned, they're under rented at the moment, which is great. But in terms of compared to what the shopping malls cost, they're far cheaper, and it's a far more efficient and cheaper way for retailers to get goods to people. So Looking at, based on JLL stats, we're seeing that the large format retail supply is about 50% below the 5-year average. Vacancy rates at a historical low of 2.5%. And there are significant barriers to entry. Obviously, you need a very big parcel of land to get, we're on over 4 hectares here. That's not easy to find, 4-hectare sites. So you've got limited areas where you can build large, bulky goods centres and large format retail centres. You've got to get the right zoning, of course. And importantly, as Simon mentioned, the construction costs have really blown out. To get the rents that you would need to build a new centre these days, they'd be substantially higher than what a lot of these tenants are paying. So it makes it challenging to get new supply into the market because of the nature of the centres. And we're still seeing, as I mentioned, the very strong demand from large format retail tenants. They're still expanding their footprints. They know that's the way they're going to get most of their goods out to their customers, is from these centres, whether people come in or online click and collect. That's the way that it's much more efficient for a retailer if someone comes and picks up the goods rather than putting on the back of a truck trying to get home delivery. So, and because of the low cost nature of these centres, where the outdoor parking, we don't need all that high cost air conditioning, indoor security, cleaning, all those sort of things. It makes it a much more, an efficient way and a lower cost per not just per square metre, but also based on their cost of goods and total cost to get the goods to the consumers. So it's one of the reasons we're really excited by it. We're seeing increased spending. The large format retail spending in Wagga Wagga is forecast to increase to 680 million. By 2036, that's an annual growth rate of close to 3%, 2.78%. And as I mentioned already, that is going to be the last mile logistics play for most retailers, is that people will come to these large format retail centres. And if they make it easy for people to come and get the goods, that's what they'll do. And so if anything, the online growth in online will actually work with large format retail and not against, because this will be effectively their distribution centre coming into these stores. So overall, we're really excited with the asset. And as I said, it's strong growth rate there in spending in Wagga Wagga. It meets the criteria for what we believe is going to happen continually in the logistics and retail space, and certainly it's a great centre as well. And obviously we've really loved the tenant mix, as Simon mentioned. We've got over 1/3 or in retail, but it has been very much neighbourhood centre, large format retail, and we're fortunate that all our opportunities have performed well in the retail space. Just give you an example of one particular fund. It was a standalone fund, quite like this one. It was in Banksia Grove, and we purchased that in November 2019. Again, good quality tenants, standalone, low cost centre. And we've got Pet Barn, Repco, 7-Eleven, Auto Barn, and Mercy Care as well. Similar flexible exit options because it's got 3 titles, so potential value add. And the average distribution rate has been 8% per annum. That's been really well supported by proactive management strategies. We added a telecommunications mast, solar initiatives. And look, if we sold that one today, investors would be sitting on 15.4% per annum average internal rate of return. We're not selling it today, but that's based on the current valuation. So these centres can perform particularly well if you get the tenancy mix right, and obviously looking at managing those centres well. It's certainly been a very good performer for our investors. I think this is another great reason why this is an opportunity. That's why one of the reasons we loved it is, right now, as we all know, sitting here in early February in 2025, we know we've seen interest rates come up substantially over the last 3+ years, and they've been relatively stable, certainly over the last 12 months. Now, the market is forecasting we're going to see rate cuts through 2025, and that is the thing that I think will fuel demand for property. A lot of people have been sitting on the sidelines, waiting for that moment. But if you've got money in a term deposit or in a bank account, your interest rates, without any shadow of a doubt, are likely to drop this year. So I think we're going to see that weight of money come back into property funds, property fund managers. So to be able to get a great asset like this at a very good price, we're certainly very excited by it. And look, rates may come down in February, they might come down in May. We don't know exactly, of course, when they're going to come down, but the forecast from many economists and the bond market and the banks themselves is that we could potentially see up to 1% rate cut this year. So that will certainly, I think, fuel demand back into property. And so I think it's an opportune time that we're able to get this asset before the rate cuts come in. And I think we're certainly speaking to a lot of investors, and those who are pretty savvy looking forward are saying, well, yeah, this is a good time to certainly park some money into a good yielding asset, because pure and simple, we know that the interest rates are going to come down, and that's likely to, no guarantees, of course, but likely to mean values tend to increase when the interest rate or the risk-free rate comes down. Of course, there is no guarantees. So it's a great asset. We're very excited with it. If investing with Westbridge, how do we go about doing that? And how does this work? Well, it's a syndicated structure. This is a standalone fund, so it's one single asset set up as a unit trust. We raise money from investors. We also source bank debt for the asset, 50 to 60%, around that sort of range in terms of bank debt on the asset. The rest comes from investors. We then purchase the property. Got to pay stamp duty, unfortunately, and other setup costs, as always comes with buying any property. But then the loan is non-recourse to investors, so the individual investors don't have any liability for the asset. We manage everything. We'll be working in conjunction with a local expert property manager, but also we handle everything from the acquisition through to managing those assets. Simon mentioned we obviously got some potential upside with the leases when they come due again, but also the ability to potentially sell it as parts. That's something we'll continue to monitor throughout the term of the fund, the ability, and is there a value add to do that, to split them up, and we might get better cap rates on some of the smaller assets, particularly if there's some investors out there who will pay a lower cap rate, or effectively a higher price. So that's something we'll be looking at. We manage that. We consistently look at all our funds and all our assets. What's the right strategy? But the good news is, of course, there's income distributions on the way. It's not a pure play value add. We're targeting 7% per annum. And there will be a tax deferred component for those people who are paying tax. If you're in super, you might not be, but if you're outside of super or you're still in accumulation phase, we're working through with the depreciation report. But the building was built only some 10, 11 years ago. So significant construction costs. There'll be quite a bit of depreciation, which means not all that money that you see pass through to you will be subject to income tax here and now. There'll be certainly a tax deferred component to that as well. So how do you invest? Register your interest, get the complete the expression of interest form. You'll find it on our website, westbridgefunds.com.au. Put in how much you're interested in investing. You'll then hear from our team, and they'll talk to you, answer any questions you may have about the fund, how it works, the asset itself. We don't give personal advice, but we're here to help you explain the asset. And then you'll get sent the information memorandum, which has got all the detail. Encourage you strongly to read that. Talks about all the returns and the opportunities, but also the risks as well. And then once you're satisfied with that, you want to invest. We've got an online portal where you can lodge your application form or speak to the team for assistance to help you through that process. Once your application is accepted, then we issue with unit certificate. So that's your share of the fund and how much you own. And that means, for example, we're targeting 7% per annum. If you put in $200,000, we'd be targeting $14,000 per annum, which is just under $1,200 a month. And we do pay these distributions monthly. And you get regular fund updates as well. We'll update you every quarter. What's happening with the asset, what's happening with any of the tenancies in particular, and also if there's any change in our strategy or update to our strategy. Certainly the first 12 months it'll be just getting the construction phase completed and getting some good income stream. But certainly we'll be monitoring when those opportunities are, as and if they come up, to potentially look at value adding and maybe exiting some of the parts. But look, that's certainly not something we're going to do straight away, but we constantly monitor that. And the good news is during that process, you'll be getting regular income stream, and we're targeting 7% per annum based on our cash flow modelling. So sum it up, target internal rate of return of 13% per annum. Obviously, there's no guarantees that will be achieved, but you've seen some of our other funds, they perform particularly well. Now, that's what we're targeting. 7% of that will be income, and the balance is targeted through capital growth. I love the large format retail sector. I think it's going to be certainly we're going to see continual stress in the high cost shopping centres as tenants they've got to get goods to their consumers and their clients. They like the large format retail centres because they're low cost, and it's a much lower percentage of their turnover in terms of rent. And so I think that sector's got particularly continued strong growth. And targeting 7% per annum distributions. You saw the tenancy mix; it's very good. And as Simon mentioned, there's quite a lot of large format retailers still not in Wagga. The value add opportunities, it's a 7-year time frame, and we believe there's certainly within that time frame enough lease resets during that process that we believe that that's a good solid time frame to get the value add, reset the leases where we can, and it's open to wholesale investors. So if you don't know what that is, talk to the key relationships team. We're doing wholesale investors only. This particular fund, a minimum of 100,000, I should say, investment. So certainly a great quality asset. We're very excited by it, and looking forward to getting it funds all in. So look, this recording and further details will be sent by email. As if say, put your expressions of interest in, read the information memorandum, and you can contact our key relationships team. Any questions either by email or pick up the phone. Our phone number's on our website, and you can scan the QR code there to register your interest in the funds. So on that note, I'll hand it back to Brad, and we're happy to answer any of your questions that you may have.
Fantastic. Thank you, Damien and Simon. Very well covered. I'll just add to that point too. Please put your registration of interest through, and that way we can send you the full information memorandum through to have a read. Those who have already registered their interest don't need to do it again. You should already have the IM, and if you haven't already got it, give me a call. All right, so let's get into some of these questions. There's quite a few here, so hopefully we'll get through as many as we can. First one, I think I'll get Damien to cover off on. Damien, the first one is, what is the expected tax deferral percentage?
That's a good question, Brad. I believe they're estimating between 50 and 75%.
Wow.
That's still subject to the final depreciation numbers, but given the asset is in that 10 to 15 year range, there's lots of depreciation left. Generally, it's 2.5% per annum over 40 years. So we've still got plenty of depreciation to come through, and that means people will have tax deferred income, so they won't pay tax on that full 7% if they're actually paying any tax at all.
That's great. And just for those who aren't familiar with that, essentially what we do is at the end of each year, we send out a one-pager, which you just pass on straight to your accountant. And it's a nice little tax deferred bonus for you to come off of that income you've earned, unless, of course, as Damien said, depending on your entity. Simon, next one for you. What is the square metre area and percentage of value for the 2 new soon-to-be completed units?
So thanks, Brad. So the Oporto and the Kickstart Coffee, they're on about 3,400 square metres of land, which of the 41,000 square metre site. They make up about 10% of the overall total value of the centre. So therefore, those will potentially be able to sell off individually on 2 individual sites. The current cap rates that people are achieving in the market at the moment on fast food outlets is pretty sharp. So there is definitely an opportunity in the future to be able to potentially sell them off individually and get that cap rate compression.
Fantastic. All right, I'll cover this one. It's an easy one. Can my super fund or a unit trust invest? Now, Damien's obviously hinted at this one already, but the answer is well and truly. Please seek your own independent advice, whether it's your accountant or your advisor in regards to what entity you do invest in. But we do find that, I would suggest more than half of the investors either go through a super fund or a unit trust in this case generally. So. Next one for Damien. How long does the individual investor need to keep their money in the fund, and how easy is it to cash out?
So it's a 7-year term fund. So these are not listed on the stock exchange. So you've got to be willing to be in the fund for that term. And so, yeah, I would say to anybody going into the fund, it's a 7-year term fund. You need to be willing and to commit for that term. You can sell units to somebody else if you wish, but we really strongly encourage people to make sure they understand that the term of the fund is the commitment to the fund, and that's 7 years.
And you'd be missing out on all that potential uplift at the end. So
Yes.
why would you? All right. Here, I like this one. How much can I invest? I'll cover that. How much have you got? No, kidding. No, look, there is a minimum of 100,000 to invest, and you must be a wholesale investor, which we can explain at any point if you need. However, it's really just going to come down to your individual diversity goals and portfolio and whatever you want to go in. We've got people that have put well over $1 million into these things. Others are quite happy to diversify and just put 100 in. It's totally up to yourself and how comfortable you are with it all. Simon, I've got one for you here. This is quite relevant considering what's been going on in Queensland. How are we mitigating any flooding risk?
Thanks, Brad. So when the property was originally developed back in 2014, there was extensive fill brought in, clean fill, mind you, and then so it was built above the 1 in 100-year flood level. And you'll see, so it's across the site, it ranges a half a metre to a metre above this level. And if you jump on Google Street View, you'll be able to see the extensive retaining walls around the site. It's probably ranging around 2 metres above the street level. So,
Yeah.
And council have actually they're comfortable with it, given the recent development approvals for Portos and Kickstart. They're comfortable with the flooding risk for the site has been mitigated.
Excellent, excellent. I've seen those photos there. It is significantly high, so that's great. One for you, Damien. How will the growth of online retail impact the future of the LFR sector? Now, I know you've touched on this a bit, but do you just want to go any further into it?
Yeah, I think I've covered that hopefully fairly well in the earlier discussions, but I think it works. They work hand in hand. Ultimately, every retailer is trying to get goods to consumers, and that they're going to generally use in their home, or if they're going out boating, fishing, camping, or something they're going to use. So it's very expensive to do home delivery, and so retailers, as much as for their consumers, they want to offer that as a service. In some cases, it's incredibly expensive for those trucks and delivery people to get it to home. So ultimately, what all retailers want is the online order that people come in and pick it up. And that's obviously cheapest distribution. And the good thing about the large format retailers and the large format retail centres is the ease. I just went and did some shopping at one of a large format retailer over the weekend. I was out of park, literally 15, 20 metres away. And worst case, you might be 50 metres away. You don't have to go through crowded shopping malls and walk 300 metres to find a store. You walk straight in and you can buy your goods and you walk straight out. So if anything, I think we'll see more distribution coming from these large format retail centres. And I think importantly, particularly in the regional areas, if you're in Sydney, Melbourne, Perth, Adelaide, Brisbane, it might be the distribution from a warehouse might be more efficient because there's lots of houses around. But you can almost say you just cannot possibly see distribution from any of these large format retailers from a Sydney warehouse. It costs them a fortune to ship. So all the goods would come to the local large format retail. That'll be their distribution model for these regional areas for certain. So if anything, I think the online complements large format retail, certainly doesn't detract from it.
Yeah, definitely. That's well covered. All right. So one for you actually, Damien. Are you concerned at all around the competition for large format retail in the Wagga Wagga region?
Oh, look, that's certainly anytime we buy any asset, we look at the competition risk. Is there other available land around that might compete with us? That's absolutely, one of the key critical things we do in our due diligence program and in selecting the asset in the first place, but also in our due diligence program as well. So, no, not particularly concerned. One of the key reasons is the replacement cost. Simon mentioned it earlier. We've seen construction costs rise significantly around Australia. I think everyone knows that, and the regional areas are not immune to that at all. So to replace a centre like this would be $65+ million. We're buying it for 45. So if someone else was to come in and try and lure tenants away, well, they couldn't offer the rents that we're currently getting, and even the market rents when these get reset to market, it would be a real struggle for some other developer to try and lure these tenants away because they'd have to be charging them substantially higher, not only what they're currently paying, but even what the market rate might be to make it economically viable. And so from that point of view, that means there's less risk of that. We also do have, though, as Simon mentioned earlier, there's 39 retailers who not yet have a presence in Wagga area. So there's always potential for more. And given the population growth that's going, the catchment's growing at 2.78% per annum. That's significant. So yes, we might see more retailers come in at some stage, but doesn't mean that we're going to see that we'd lose traffic, if anything. That population growth is pretty strong. So we'll expect to see retail turnover increase. There is a Bunnings that owns a site there. They're going to likely move into that for a new store. From what our research, it's only really big enough to cater for a Bunnings. So there's not likely to be any large format retail attached onto that. And generally, Bunnings like to be standalone anyway. They don't like too many other retailers around them. So we're looking at other sites in the centre. There's nothing that really stands out with the appropriate zoning. The old Bunnings would likely get backfill. Just noting the area, it might be like trade retail, more likely than consumer retail. So as examples, I'm not saying these tenants would go there. Your Kennards, Hire, your Reece Plumbing, those sort of things. I'm not saying they're going there, but that's more the appropriateness of that current particular site. There's not a lot of where we can see big sites where you could do a lot of large format retailer. But the big one is, even if there was sites, and maybe at some stage, in the years ahead, there might be zoning opportunities, it's the replacement costs and the rent you'd have to get that really help protect this asset and these tenants. They're even if they go to market rents, it still makes it very, very hard because of the replacement cost now for someone to come and build new centres. So certainly our research indicates that, and indicates that it's low risk. Nothing's obviously risk free, but we're certainly very comfortable in proceeding with this asset that and as Simon also mentioned, I think that's critical. It's on a major thoroughfare. Retailers like to be where it's widely seen and on main thoroughfares and not out in the back blocks and hidden away. So that's the other thing I think really helps protect this asset in case something else comes up. The retailers want to be on those busy strips.
Well, surely.
Yeah.
All right. So one final one. I'm getting the wrap up soon here, but one final one for Simon here. Why does Westbridge consider the tenancies to be under rented?
Brad, a lot of these rents were set 4+ years ago, and in the last 4 years or so, there's been some significant growth in large format retail market rents. Now, the average rent across our centre is $179 a square metre net. Now, we've done extensive research with JLL, and the latest deals that these LFR centres are getting in the regional New South Wales locations are 250 to 300 square metres net. So we think there's going to be really strong market growth and rental uptick in this centre, especially when, and sort of mentioning what Damien just said, is the cost of construction so high. And if you can find the appropriate zone sites large enough to accommodate new development, there's no vacancy in any of the large format retail centres. We're one of two in Wagga Wagga, and there's no vacancy at the moment. So, we think this centre is well positioned to achieve some good, strong rental growth.
Well covered. Thank you. Apologies to everyone if we've not covered off on your queries. What we will do is post this. We will give you a call or shoot you an email to cover off on anything that hasn't been covered. Thank you, Damien.
My pleasure, Brad.
And thank you, Simon.
Thanks, Brad.
And hope everyone has a great day.
Thank you.